better. Stay safe, stay well. Namaskar.
Well, I think the governor has achieved the Shaktikanta put. We always spoke about the Fed put, and what we have now is the RBI put. Everybody was wondering whether the governor can sound as dovish as he sounded in September, and I think he has. They have upped the inflation targets considerably. From 5.4 to 4.5 was the original second half forecast for the current year, and now it is 6.8 for this quarter and 5.8 for next quarter. That's a substantial revision by about 1.5 percentage points on an average across 6 months. And the average for next year, first half also, was around 4.3, and now it is revised up to 5.1 percentage point higher. And yet there is no difference really in the language. I didn't hear the word look through, but the market has looked through the absence of that phrase. Both the bond markets, and we should pull up the yield is down by 1 basis point. We were at 5.92, 5.93 going into the policy, and now we are at 5.91. Oh, 5.90. So market quite clearly has taken this as a very dovish policy, and why not? In spite of the upping of inflation numbers, forecasts, there is absolutely nothing to touch the amount of liquidity. Yes, rural RRBs are allowed to access, but it's not the mutual funds or any other entities that have been allowed to access the reverse repo. No effort has been made to pull up the overnight rate. The overnight rate is close to 3%, the rate at which banks exchanging money with each other. That is not being pulled to the reverse repo rate. That continues to remain at a good 25-35 basis points below the reverse repo.
Absolutely. So no announcement whatsoever ever on liquidity, only the promise that in future, as and when there is a need, there are many tools available and they will be used by the RBI. A few other non-policy announcements. One is the on-tap LTRO, for funds that have been covered, for sectors that have been covered under ECLGS 2.0. So we're talking about the 26 stress sectors plus healthcare. The revised guidelines on credit default swaps are also likely to be announced. Most importantly, risk-based regulation, supervision of cooperative banks, and for NBFCs there will be a size or scale-based regulation. So that is another important guidelines that is expected from RBI that we should watch out for. But overall, markets are happy that there's a withdrawal of liquidity from the system.
Yeah, and you put your finger. The first point you made, I think, is very important. That they have all these tools and they will use it in good time. So as and when they think liquidity has to be drained or the low, near-term rates are going to be pulled up, they will be used. But as of now, I think the governor has not done anything, would not want to perhaps even upset the mark-to-market gains that banks are making. If they were to pull up the yields in some fashion, there could be mark-to-market losses, and you don't want banks to suffer any losses at this juncture. Maybe whatever will come after January, after the third quarter numbers are through. Well, that's my guess, but we have much better people to tell us how to read the policy. Neeraj Gambhir, Anant Narayan, Mallikarjun Rao, and many more experts in financial sector are joining us. Neeraj Gambhir, what is your key takeaway? You expect overnight rates to continue to remain below 3.35. Any other key takeaways?
So the first and foremost and the most important key takeaway for me is that while they have, upped the growth forecast a bit, and it is very close to what Axis was forecasting at about 7.5%, the statement that the recovery is not broad-based and it is dependent upon the support that has been provided by policy, both fiscal and monetary. So I think that's a key statement for me, because it feels like that while there is a change and improvement in the forecasts, there is still a bit of uncertainty as to how things will play out over a period of time. And clearly MPC has adopted a wait and watch approach at this point in time, and clearly has not changed any of the language that it had given us in the month of October. It would have been too soon for them to change the language. Credibility is also an important factor as far as MPC is concerned. So I think that the absence of any liquidity measures is also designed to make sure that the low interest rates, which have sort of been, which have prevailed in the system, continue to prevail there for a somewhat longer period of time, because the governor also took, considerable amount of effort to explain the fact that the low corporate bond yields have actually aided and helped in the entire stabilization process.
Okay.
So I don't think they have kind of, they want to tinker with it at this point in time.
Okay.
But we will continue to watch this space.
Got that, Neeraj. Well, I just want to point out, and our lines are screaming, which is why I didn't say, the Nifty touched, the Sensex touched 45,000 and the Nifty is well above 13,200, was almost touching 13,250. The biggest spur is coming from the Nifty Bank. That went up by 1.6%. I don't know if it touched 30,000, but I mean, it must have gotten pretty close to that. Now there's a little bit of profit taking coming in. Banks extremely gung-ho that the liquidity is left where it is, but we should take on board what Neeraj is saying, that they are cautious also about growth. Sajid Chinoy has also joined us, and I invite Sajid Chinoy. He's also a member of the PMEAC and a close watcher of the numbers. Sajid, what have you taken away in terms of growth, inflation, more importantly, liquidity?
Well, I think on growth and inflation, Lata, the trends are now very clear. For the last 6 months, we had elevated inflation, but growth was decelerating. Now the RBI has got much more confidence that growth is inflected. This was a substantial upgrade to its growth forecast. They forecast positive growth in the second half of the year. So there's more confidence here that the economy is on a relatively strong recovery path. I think the question is going to be inflation. And I think today the balance was, on the one hand, how do you acknowledge that inflation has been tracking substantially above the RBI's previous forecast, but at the same time not spook the bond market? Because I think the key objective in this exceptional year has to be to ensure that the government's borrowing program goes through non-disruptively. So I think the RBI leaned on the latter to say we're 3 months away from the end of this borrowing program. There's still some uncertainty about growth inflation dynamics. Let us lean in the direction of ensuring that bond yields don't harden disruptively. Going forward, Lata, I would say the key thing to watch on inflation in the next 6 months is not so much headline, but it's core inflation. Because in an unprecedented shock like this, when both demand and supply have been simultaneously affected, we don't know how much of the impact is cyclical versus structural. My sense is over the next 6 months, if core inflation momentum begins to come down, even if the headline takes longer to soften, the RBI will heave a sigh of relief. If core inflation continues to surprise to the upside and we get closer to the borrowing program, then I think the central banks and the MPC will have to get progressively cautious. So I would look very closely at those core inflation outturn in the coming months.
Okay, Ananta, what were some of your key takeaways? Inflation forecast upped, GDP also revised higher, a few other, liquidity-related measures that we were expecting. None of those were announced.
Yeah, just